Tesla stock and Netflix stock both have dipped on earnings. Is this a buy the dip scenario? Are these stocks still overpriced? Is it the beginning of doom and gloom? Well, I don't know about doom and gloom, but I do have some opinions on the valuations of Tesla and Netflix. So, what is the situation? Is this an opportunity? Is there value here now? Well, I think we should look first at some financials on Tesla, just to give you a little bit of a rundown of where they've been and where they could be going. They've been a growth machine pretty much the entire time they've been a publicly traded company, okay? As far back as you look, and this goes all the way back to 2013, you see a lot of growth numbers. Now, you do see some dilution as well, but the growth does seem to outpace it substantially, which, you know, it's probably better for their balance sheet that they don't have to take on debt. But the reason they're able to fund their operations with dilution is because they do trade their shares at a bit of a premium, in my opinion. Bottom line growth has started to really come along lately, just as impressively as their top line growth. All right. A lot of credit to Tesla. I think they're a very good business with a very bright future in the long run, okay? I don't think Tesla's going away. Don't think they're going bankrupt. I think that it's a business that's going to be here for decades and decades, all right? Now, that being said, even if they'll be around, the thing that's going to determine your return is how much you pay today for that future stream of earnings or cash flow, all right? So, if we look at the analyst estimates for their earnings growth, they're estimating that there will be a big jump in 2024, over 40%, up to $5.18. Now, after that, it slows down, 17, 12, 12, right? And you could probably guess that as time goes on and on and on, that growth rate will probably continue to kind of level off into more reasonable, maybe mid to high single digits as the company matures, right? This is a normal thing you see with every business. Over time, the growth rate just simply slows down because their core business has kind of penetrated the market and gotten, a certain amount of market share. And at that point, continuing to grow, you run into a little bit more resistance, okay? So what is an actual reasonable price to pay for Tesla? Well, I've given price targets in the neighborhood of $90 before, but I thought, hey, let's give Tesla a little bit more credit this time because of this dip and just, paint a little bit of a rosier picture than usual. So I gave them credit for $5.20 of EPS as a starting point. That's assuming basically that the 2024 prediction from analysts on earnings come true. They had 518, I just rounded it to 520. We've left the discount rate as the standard 10%, okay, because that's been the average of the S&P over like the last 40 years. Now, when it comes to EPS growth, all right, we've got 10 years of 10% growth and another 10 years of 6% growth in the model. That gives us a fair value of $110 today. If you wanted to match the market and you believed these assumptions, and also give them credit for their balance sheet. Now, that's less than half the current share price. Now, you might be saying, hey, you're being a little stingy with that 10%. Well, keep in mind, we're jumping forward a year and giving them credit already for that big 42% jump that they have not achieved yet, by the way. And we also have to take into account that the analyst estimates only go out, a certain amount of time. They show it going down to 12 by, 2026. But they don't really give you a clear idea of what will happen after that. But the general, reasonable assumption is that it goes down as time flows and they become a bigger and bigger business with more and more market share. The more market share you have, the less market share there is to capture. All right? That's just how percentages work. But hey, you know what? Why don't we, pump this up to 15? Okay? Let's be a little more generous and say that it only drops to 7 after that. Okay. Well, we're still, over $100 overvalued. And remember, this is giving them credit for the big jump. And then this is saying that they sustain double-digit growth in the mid-teens for a solid decade with no stumbles. All right. And that even after that 10 years, after they, would most likely really start to slow down, still it only slows down to a 7% growth rate in their earnings per share. Is this reasonable? I mean, I think this is pretty generous. And even with it being generous, we're coming out with a fair value of $152. Okay? So I thought the assumptions that got us to the $110 point were actually pretty generous. But, you be the judge. You tell me if I'm being too conservative. Now, one of these companies is actually going to end up a little bit closer than the other. I won't tell you which yet. But why don't we look at the numbers for Netflix now? Their financials, real quick. All right. So you get a similar pattern of growth, right? And, bottom line, mostly growth, but there's been a couple stumbles in here, okay? So not 100% rosy in all cases for Netflix, okay? And, that's a little bit more realistic, okay? Even big, yet fast-growing and really well-run businesses can have these outlier years where they have these, big stumbles and then they rebuild from there. And that's happened a couple times here with Netflix. One of them just, 2022, their EPS dropped by 11.48%. Now, that may not be the, end of the world or anything, but you also have to keep in mind their free cash flow seems to be lagging the earnings by a pretty good amount. Now, could this be because they're doing a lot of capex to grow the business and things like that? Yeah, sure. That's that's a reasonable argument to make, but still, at some point, the cash that comes in matters. All right. So, even still, we will do some slightly more generous assumptions than what I might usually do. All right. We will forecast their EPS by first looking at the analysts again. Now, the analysts are predicting a jump of 28% in 2024, and then 25 dropping to 18 thereafter, up till 2027. They don't really give us anything after that, and it's fewer and fewer analysts going from there, but, it's at least some kind of a starting point, okay? So, what I've done is I've, again, given them credit for the 2024 number, even though they have not achieved it yet. Now, I did dock them for their tangible book value. It seems that they have more debt than tangible assets. Now, they may have, a certain amount of intangible assets that, you could maybe make an argument that this is maybe over penalizing them. But we'll just leave that there for now, since I did the same thing for Tesla and gave them the check mark for their balance sheet. It's just theirs was better. Now, for the next 10 years, we've given them credit for 15% growth with 7.5 thereafter. We've left the discount rate of 10%. Now, this one, if we believe those assumptions, which I think are pretty generous because we're giving them credit for things they haven't achieved yet, and then saying they will sustain a pretty beefy level of growth for the next 10 years with, again, this doesn't allow you to, throw in the odd stumble. This is kind of just 15% CAGR, basically, we come out with $363 per share, which is, a little under 17% overvalued. Now, this is a lot closer than Tesla, but we're giving them credit for things they have not achieved yet, on the one hand, as our starting point, and assuming, a picture that is pretty darn rosy for a very long period of time. I don't know if they can do it. But again, if Netflix were to, have another drop again, and they were to, get to the 350 range, I mean, and it could happen. I think it has happened where they've even been lower than that in recent past. They may actually be worth a closer look at that level. But I would, at that point, dive a little bit closer into the 10K and what these future growth projections are based on. And I would also be very closely examining the cash flow situation and the debt situation, because at some point they do need to have their cash flows somewhat catch up with their earnings, because being cash poor is not generally a good thing for businesses in the long run. But those things aside, there could be something here with Netflix if it took another very substantial dip. But that has yet to occur, and these assumptions give them a lot of credit, okay? I would personally beat them up a lot more than this to get to my number, and really stress test them quite a lot. But that's just me. Let me know what you think about this earnings season and these dips. Let me know if you own either Tesla or Netflix, what your cost basis is, or if you don't, what your price target is on those two companies. In any case, I hope you have a wonderful Friday, because it's Friday, gotta get down on Friday. Make sure you like and subscribe, join the Discord, hit the join button, become a member. Remember, when I get 10 channel members, we're at 3 right now. Thank you for the first 3 people who broke the ice on that. We'll be doing something really special with the YouTube portfolio. Take it easy, everyone. Have a great weekend.